It's Wednesday, July 30th, 10 a.m. Pacific time, and I want to go over possible adjustments to a Strangle I currently hold in iBit, which is a iShares Bitcoin ETF. All right, so the current position is a Strangle that expires September the 19th, 51 days away. And what I did here, I believe I legged into this, so let me double check. Let's see. I did leg into this. So the first leg of this was selling a put on July the 25th. So that was this past Friday, 5 days ago. I sold a put and I received a buck 95 for that. The market rallied a little bit. The put became profitable. It's still profitable. And then I sold call to 78 strike for $1.45, I believe. Let me double check. $1.40. Okay, so the construction of this position brought in a $335 credit, which is the sum of the credit received for the put and the credit received for the call. All right, let me quickly go over the Greeks on this so we can see what's up. We can ignore this position. This is an old position that's been hedged and risked away. Anyway, all right. So the put at the 60 strike that I sold is has a share equivalency of 21 delta, and the call has a share equivalency of short 18 and a half-ish, let's call it. The time decay, the theta on this, is collecting roughly $5.50 a day, and that's the sum of the theta for the put, which is 2.8, and the theta time decay for the call, which is 2.7. See that these are options that were sold, so the position is going to have negative gamma, which is roughly 5.3, and short vega. So this is a short volatility position overall. Now, it is currently the position, I'm just going to use the mark that's here on the trading platform. It's 227-ish, and I did sell it for 335. So it has a little more than $100 in profit right now. So what adjustments can I make, if any, if I were interested in making adjustments? So let's take a look. One simple thing would be to close both legs, close the position, and it would provide me with roughly $100 in profit. But I don't want to do that. There's still plenty of time to go. I can receive time decay. Volatility can decrease by more than it has. So time decay and vol decreasing will make the position more profitable. If I wanted to do something, one thing I can do is I can buy the 59 put, and I can buy the 79 call, and let's say that I get 88 for that. I'm going to use the ask on each option as the price that I'll pay. So 88 and $1.12 is $2. So let's say that I pay $2 for this. So what happens if if the price of iBit either skyrockets beyond the call or plummets and drops below the put that I have at the 60 strike? The risk profile is the following. Notice that any price that would breach either end of this position, now it's a condor, it would be morphed into a condor. I can't lose money. I would make the worst case scenario is $35, and that's basically derived from the credit received of $335 for initiating the Strangle. I morphed it into a condor, and that cost me $2, so I have $135 profit there. So again, if it breaches the strikes on the lower end, on the lower bound or the upper bound, one of these spreads, in this case, let's use the 60-59 spread. If prices go below that at expiration and expires there, I would lose $100 there, but I have 135 locked in. So the worst case scenario is a $35 profit. And remember, I have 135 locked in, so prices within the bounds of the strangle that was initially constructed, I would make $135 if I paid $2 to morph this into a condor. All right, so that's one possible adjustment that I can make, but I'm not going to do that. I'm just toying around with this as a way to think about what can and cannot be done. Let's continue. Let's say that I suddenly became, for whatever reason, I suddenly became extremely bullish on volatility. Not direction, but volatility. So I think there's going to be a big move one way or the other. One thing I can do, let me go back to the table here, is how about if I did this? I buy the 61 put and I buy the 77 call. And let's just say this cost me $265. All right. So remember, I initially sold the Strangle for $335, and I'm morphing it into a bullish condor for the price of $265. So that leaves me with $335 minus $265 is $70. So now in the worst case scenario, I will make $70. Okay. And that's within the bounds of 77 on the call side, 77 on the upside, that's the upper bound, and 61 on the lower bound. So no matter what happens, I make $70 in there. And if there is an explosive move one way or the other, then I end up making another 100 because one of these spreads, one of these vertical spreads will go fully in the money. So if IBIT rallies, I would make 170. If IBIT drops a lot, I would make 170. And if it stays within these bounds, I make 70. Now that I can do today if I wanted to do that, but I don't want to do that because at this point I'm still cool with allowing time decay to do its thing, and I'm also basically holding the opinion or the view that there will not be an explosion in volatility. So I'm not interested in making the adjustment that I just covered. So for now, I'm going to stay short vol. I'm going to let time decay do its thing. And if I need to make, if I feel I have to, or I want to make any kind of adjustments, I can take it on a case-by-case basis, so to speak, and see how this develops. All right, I hope that was helpful. I'll catch you guys next time.